Okay, I'll just check that you guys can hear all right. How's sound over here? Sound okay? Does sound okay for you guys? That's a nod. Okay, that's good. What about you guys at the back? Sound okay up there for you guys? You want a bit more? Okay. Okay, how's that? Is that better? Is that better? A lot more. Oh. Okay, is that all right now? It is. Okay, and you guys okay? Good. Right, okay, well, it's time to start, so we'll make a start. The fifth and final online quiz is next week, and it will include the material from the overview through to the end of this topic here. Now, the only drawback is that this one usually takes about 3 lectures, so we'll start it today, we'll do more on Friday, and then we'll finish it Monday, and of course the quiz starts on Tuesday. So, if you want to study ahead, there's no problem with that. But I'll give you more details on Friday on the structure of that online quiz, that fifth and final one. But this topic here will be included in that. Okay, so we'll make a start. This puts together 3 groups of companies. Often they have some commonalities around what they do. But the insurance, investment, and superannuation are things that pretty much everybody at some stage in their life has all of these. Whether you have insurance now, whether you're investing now, or whether you're investing for your superannuation now, it's very likely that if you're not, then sometime in the not too distant future, you probably will. So this is an outline where we're going to go. The slides themselves are in 2 sections, and so we'll talk primarily about insurance in this particular set of slides. So cover an introduction to it, what makes a risk insurable and what not. A couple of types, life and health, property and casualty, another group, and then some important issues for the companies themselves. And the second group here, from here down, the superannuation and pensions, and the investment companies are in the second set of slides. So we'll come to that once we finish this. So everybody faces risks throughout their life, and you've got to essentially assess the risks that you have and make appropriate decisions about what are you going to do about those risks. And they can be anything, from small, something like someone stealing your calculator the day, the week of the test, to if you're a business and your business is disrupted for some reason and you may be out of income for a long time. And you have to assess the level of risk and make some decision about what you're going to do with that risk. And it's fair to say that some people don't even think about these risks that they face, and so they end up making a bad decision, even if it's a bad decision by neglect. So ultimately, you do have 3 choices, and they're not completely independent of each other. And the first one is you can simply retain the risk. And the example of someone stealing your calculator the week of the exam, the cost of the calculator is sufficiently small that probably no one would try to go and buy insurance on a calculator. And so if you do experience that type of a loss, then you would simply go and spend the money that's necessary to go and get another one. Now, the second group there, the loss control, one of the things that insurance does, it gives us incentives to engage in loss control. But this is primarily the area of engineering. So if you think about, a building like this, you probably can see the sprinklers up there. Most of those are automatic. A fire actually broke out, and for real, those sprinklers should come on automatically. And the idea behind them is not to stop a fire from ever happening, but if one ever did happen, then it limits the amount of damage that would occur. And there's many things like that that you can engage in, or some engineer has engaged in on your behalf, which gives you some protection against the risks that are there. And then the final one is, once you've done what is reasonable, made a decision about which risks you can hold yourself, which ones you can't, engage in loss control where this is possible, you can go and buy insurance to actually transfer that risk to someone else. And it's important to point out that it's the economic consequences of the risk that gets transferred to another party. And often, if someone suffers a house fire, if house is badly damaged and the contents is badly damaged, burned or destroyed, often there are other types of losses, sentimental value, items of sentimental value are lost or destroyed in those fires, and insurance just simply cannot cover you for that type of loss. But the cost of rebuilding your house, of buying new stuff to go inside it, then an insurance can cover that type of loss, and that's an economic loss. That's a dollar value loss that can be transferred particularly to an insurance company. So to make it work, and we'll look at this in a bit more detail, you basically have to find a bunch of risks that are reasonably similar, that you can actually put together in a large class of things. Like, for example, if you think about motor vehicles, although there's a lot of different types of motor vehicles, a lot of different types of drivers, they're sufficiently similar that you can actually do some reasonable statistics on the types of losses that occur, and you can work out the average loss, and then you can actually work out what you should charge for insurance. The other thing about insurance is it is what we call a pure risk. So that's different from the type of investment risk that we've been talking about up until this point. Pure risk is there's basically two outcomes. One is there is nothing wrong, everything's fine. And the other outcome is that there is a loss. And for example, if you own a car and you drive it to university each day, you can think, well, there's two outcomes to your trip. One is you get here fine, the car is fine. And the other one is that there's an accident along the way, your car is damaged, and of course there's a loss in that case. And those two outcomes, that's what makes the thing what we call a pure risk, and it's different from an investment risk, which people take investment risks for the purpose of trying to gain by taking that risk. So with these types of risks, there's no gain to be made by taking these risks. These are risks that you face, and it's either everything's fine, which is in most cases that's how things work. Like think about fire insurance on your house. Most houses do not burn down, but some do, and in those cases, a loss occurs. So it's either things are fine, no loss, or typically a fairly big loss. Now, insurance as a service, it reduces our society's costs of bearing these risks. And if you think about, a house. If you're trying to make a decision, should I rent a house to live in, or should I buy a house to live in? If you're thinking of that decision, if there was no insurance available for you, so you could not insure your house, that changes the structure of that decision. And often in that sort of situation, the cost of owning a house may be too high because it may burn down, and you don't have the financial resources to sustain that type of loss. And so we can spread these potential losses across a lot of people, then put them together in a company, and we can actually reduce the cost of that. So if you're thinking about, how much money would you have to buy a house, it's not just the price of the house that you would have to have. You would have to have more to cover the fact that the house that you buy may get damaged. So one of the things it does reduce the fear of these losses. In one sense, it doesn't change the probability of the loss, but it does reduce your fear of the loss if the economic consequences can be transferred to someone else through one of these contracts. And one of the other things that the insurance does for us, and I'll tell you a silly story in a minute about this, it provides an incentive for loss control. And if you think about, and we'll come to this a bit more, about what actually is the premium, what does a premium represent? The biggest chunk of the premium is the expected loss. And you think, how does that work? Because, like say you have a $500,000 house and you pay $1,000 for your insurance. The biggest chunk of that $1,000 is the statistically expected loss for your house in terms of damage by fire. And this is sort of like when the pure risk comes into it. Either your house is fine, never burns down, or like you sustain like maybe a $500,000 damage if the whole thing is burned. And so the cost of those premiums, they reflect both the probability of the loss and the size of the loss that occurs. And if you are charged this fee, maybe there's steps you can take to mitigate the risk that would then make the insurer give you a lower premium. Some specific ones that are, if you have a burglar alarm or you have extra security on your house, typically your contents insurance is lower. If you're a driver and you've taken the defensive driving courses of some sort, you pass, you bring the certificate in, they'll give you a lower premium on your car insurance. Other things that insurers do, they give things they call no claims bonuses. Basically, if you do not claim on your policy, typically they'll lower the cost for you. And so that gives you an incentive to try to manage whatever the risk is in such a way that doesn't occur. And the other thing they do is they charge what's called an excess. And basically, if there is some loss, you actually pay the first little chunk of it. Now, this one here, this is a true story. You might find this hard to believe. I swear this is true. I was in this meeting with all these other economists, and Bill English was there. He was Minister of Finance at the time, now a Prime Minister, and he was supposed to come down and talk about problems that come out of the earthquake and good economic solutions to these problems. And one of the guys, who shall remain nameless for the protection of the guilty, of course, said, all these new regulations on the earthquake strengthening, that you should do on these old buildings, and all you shouldn't have them. What you should do, and this was his argument, I kid you not, he said, you should make them buy an insurance so that if their building kills someone, that they pay them $4 million. Okay? And his argument, which you know the saying about economists, they know the price of everything and the value of nothing. But his argument was that instead of requiring buildings to be strengthened so they don't fall down in an earthquake, if you charged them a significant premium according to their risk, they'd figure out whether they needed to strengthen their building or not on their own. But anyway, that's only economists would see it that way. But if you think about things, insurance provides incentive for loss control. If they took that route, then this would be the incentive for someone to strengthen their building, so they didn't have to pay this insurance that's paid $4 million for everybody you killed. But anyway, if you come back to the real world, it still is an incentive to try to control the losses. Anyway, moving on. Another service it provides is providing what we call collateral for goods in transit. If you remember back when we were talking about the banker's acceptance, what you had to do to get a banker's acceptance, one of the requirements typically is that the goods being shipped are insured. So when you think about what papers are required for the bank to turn their initial letter of credit into a banker's acceptance, typically one of them is that you have to have insurance, and then there'll be some certificate that says you've got it. Now, the insurer assumes what we call the objective risk. And it's kind of technical there in the way it's put, but the idea is quite simple. So we say it's the deviation of the actual losses from the expected losses. If you think back to the fire insurance on a house, if you say, look across thousands and thousands of houses, let's say on average, over long periods of time and thousands of houses, that the average loss is $1,000 per year per house. That's here, and so that becomes the basis for the actual premium. And so what the insurer does is it takes whatever deviation between that statistically expected losses and the actual loss. And in most cases, the actual loss is zero. So this works in their favor in that case. If you get the bad case where there's a fire and the house completely burns down and they have to restore it, there's a huge difference between the $1,000 expected and maybe $500,000, for example, actual. And that deviation between expected and actual, most of the time it's zero, but occasionally it's an enormous one. That is the objective risk that they take on, and that's how they make their business. Now, in terms of the financial system, in addition, they are quite an important part of the system in raising capital and making investments. In fact, we'll talk a little bit more about their balance sheet further on, but often when you look at who are the big buyers of something like long-term bonds, typically things like life insurance companies are big buyers of long-term bonds. And basically what they do is they take in comparatively small amounts of money on a regular basis, and they pool these together, and then they invest them in the capital markets or the money markets, as the case may be, and then they use that to pay out when they're called upon to do so. So, insurable risks. So what are requirements for a risk to be privately insurable? Let's think of two things. Let's think about buying a car. Say you go to buy a car and you may sign the dotted line there at the dealers, and then you ring up either you ring up with your insurance company, or you may go and see them, and you give them a few details: what the car is, who you are, how long you've been driving, whether you drink, what your age is, blah blah blah, and pretty soon, in a few minutes, you have your insurance. Great, that works. Say you wandered in to an insurance company like State, and you said, "Oh, actually, I'm about to launch a satellite. It's worth $300 million. I don't want it to, go boom, but sometimes they do. So I want to buy insurance." And they say, "We don't do satellites. We don't do satellites." Why can you wander in and get insurance on your car, but you can't get insurance on your satellite launch? Yeah, go ahead. Well, the risks are quite different. In what way? In what way?
In the fact of the size of what's at stake, and also the variables are very different for a car than for a satellite. Like, obviously, you're not going to have a bus crash into your satellite at 33,000 feet. So, yeah.
Okay, so in one sense, because with the cars, there's lots and lots of them. Okay, you're in one sense, you can sort of figure out what on earth this thing's going to cost from an insurance point of view. The other one about the satellite, basically your issue there is you haven't got a lot of data about how do you think it's going to blow up. Okay. Did you have another point?
I was just going to say the risks are more known with a satellite, something with a car than with a satellite. And with cars, you can insure lots of cars, so you get close to the actual probabilities of long run. Whereas if you insure one satellite, it either blows up and you lose a whole bunch of money, or it doesn't blow up and you make some money.
Yeah, so the issue there is one about the satellites is it's a really lumpy thing. Now, it doesn't mean you actually can't get insurance on these things, but you have to go to some specialist ones. You can't sort of wander in off the street and get insurance on that sort of stuff. But something like, cars, because, when you think about what we talked about, how insurance works, I mean, you can estimate the likelihood of crash. You can also estimate the likelihood of loss based on who the driver is and what type of car it is, and think like if they have a little subcompact, the likelihood of loss would be different than if it's a high-powered sports car. But you can work that stuff out because there's enough of them. And of course, there's lots of them, so you can actually spread this across a lot of them. Any other things that we would require before we as an insurance company would take on a risk? Right, there's a few more. That was quite a big one. One of the things is this one here about unintentional, random, occurring by chance is an important one, because what we really don't want is risks that are actually highly correlated with each other. So if person A does make a claim on their insurance, we essentially want that claim to be independent of all other claims of a similar type. So this one here, which sort of links to this one, losses which occur independent of each other and not all at once, such as a flood, which can wipe out the insurer. So you can think about cars, people driving around, and yeah, sure, on wet days, there are more crashes than there are on dry days. And if it's foggy, there's more crashes than if it's sunny. But they're relatively small deviations. So there's tiny amounts of clustering there. But over a year, you can work out what this is across these thousands of cars and thousands of drivers. Now this one here, how many remember AMI before it went bit the dust? Yeah, one or two people still remember AMI. This is something most people aren't aware of, that AMI actually knew what would happen to them if they had an earthquake in Canterbury. They knew they would go broke. And so in one sense, what they were doing is that they actually understood the risks that they were taking, and they decided not to charge enough money for the policies, and they knew that we had a major earthquake, they would probably go bankrupt. And lo and behold, we had a major earthquake, and they did go bankrupt. And what people count on is we count on the insurance company not doing that. They count on the insurance company actually calculating the risks and then pricing that risk correctly. They never figure on an insurance company deliberately not charging what they know to be the correct amount. And so some companies just don't do this. So things like floods, earthquakes, tornadoes, probably a little bit too narrow, but maybe something like a typhoon or a hurricane, some companies simply do not insure those simply because they have this all or nothing type quality to them. Either nothing happens or you get a major problem with thousands upon thousands of claims. And when you get like either nothing happening or thousands of claims, that tends to put it outside what many private insurance companies will do. And so because of that, there's often government agencies will actually step into the breach to provide insurance in those types of circumstances. Final one, when you actually charge people for this, it's got to be something that's feasible. Okay, so can't charge too. If it's too expensive, then people will not buy insurance. Okay, any question there before we go to regulation? Okay, so regulation, in Australia, the insurance industry is regulated by APRA, so that's the prudential regulation, regulated there, and so they are looking at the risks that they're taking and basically providing regulation around the risks that they're taking. And so when they're looking at them, they monitor their capital requirements, how much capital they need to have, and also they look at their liquidity management because, when you think about if you're going to make a claim, they need liquidity to pay you out. They can't say, oh, we've not got no liquidity this month. Wait, next month we'll pay you out. They have to be able to pay out as necessary. The capital requirements, again, they're there to absorb losses because sometimes, these things will cluster and you'll get higher losses than you expect, and you need capital there to absorb those extra losses. And in the book, it talks about of the failure of HIH, insurance company in Australia, and that's the thing that sort of drove all their regulation changes that made them so resilient going into the financial crisis. That it didn't actually go bankrupt, but at the time that they put it out of its misery, it was down to 1.7% capital. So it wasn't quite there, but it was almost going out of bankrupt. And of course, we benefit from this because lots of insurance companies that we have here in New Zealand are Australian owned. And of course, because they are subsidiaries or wholly owned parts of these things, the Australian regulations, they do apply to us. Okay, any questions on that before we go to the next one? Okay. So what are you going to think about as an insurance company when you set the price on an insurance policy? What have you got to consider when you're going to set the price? Very quiet. Right. Oh, we'll roll over and see what we have this. Right. So first thing up is this expected losses, and again, this word expected, we mean that in a statistical sense. Basically, you never know whether any individual will claim, any individual will have the risk and then come and bite them. But you take a large enough group, then you can actually estimate this. And often it gets quite sophisticated if you want to put in different risk classes. As long as you've got big enough groups, then you can do that. So for example, for cars, if you have a motor vehicle insurance, the risk of damaging something like a subcompact, small car, is quite different to an SUV. In fact, one thing I should tell you, if you're ever thinking of buying a car and you want to know what it's like, one of the things that you can actually do often is you can ring up your insurance company and ask about it. Because I remember doing this once, asking about some of you may remember the little Honda CR-Vs. Do you remember those things, a little small car? I rang up, and I was thinking actually buying one, and I actually rang up the insurance company, and they said, "Oh no, don't buy one of those." They said, "They're so bad, we don't even insure those." because they're under-engineered. Basically, there's two states here to your CRV. No, not even CRX, actually, CRX. Yeah, is that either they're fine or when they get hit, they're almost always written off. And I was quite surprised that they, I never thought that, but when you think about it, it's quite obvious because they collect that data all the time. And they said, oh yeah, if you want to buy a car and you want to know what it's like, give us a call. So if you think you buy a car and you want to know what it's like in terms of resilience and getting smashed, talk to your insurance company. They don't know if they always will tell you that, but often they do. On top of that, you got your operating costs as a business, and then money, because you're in business for profit. And then the other thing about them is that you got to take account is how much can you actually earn on the money you take in, because you're going to be taking money in from your policies, but you're not immediately paying it all back out, and so you're going to invest that. And the question there around that is how much investment income you're going to earn, and that will adjust it. And then here in competition with all the rest of the world, you may have to make some adjustments because you don't want the person to go down the road to the next place. Now, insurance pricing, it is a pretty technical field, and does anyone actually want to be an actuary here? Maybe one guy does. One? Okay. Yeah, there are about 180 fully qualified actuaries in New Zealand, and every time somebody sees that they've got 120 trainees, they go, oh man, we'll have a lot more soon. In actual fact, it's really tough, and the vast majorities don't complete. If you want to be an actuary, typically what's required as a bare minimum is a first-class degree in either mathematics, statistics, or physics to get in. Be accepted for training. And then, of course, the vast majority of people actually start this training don't finish because it's very difficult. Are you BCom or are you a financial engineering guy? That's the one to do. So if you want to do actuary and you want to do finance as your major, I mean, you should be doing a Bachelor of Science major in financial engineering. You shouldn't be in the BCom. So good on you. Anyway, as you might expect, they do get paid pretty well for this work. They make quite a bit of money. Pretty hard. Actually, pretty hard. In fact, the guy who was the actuary at AMI, there's a set of 15 exams that you do, and in the last one, which is one that sort of gets you that final qualification, you're only allowed to sit it 4 times. And if you fail 4 times, then you don't get it. He did actually fail it 4 times, and he applied for a special exemption to have a crack at it the 5th time, and the 5th time he actually got it. So, and he had a first-class honors degree in statistics, I think, when he went in. So this stuff is pretty tough, but then, you do get paid pretty well if you do this. Okay, the second, similar thing, talking about the interest rates, because you're going to be investing, you tend not to have large investments in things like equities or derivatives, not exotic stuff. You tend to be looking for something reasonably safe, and so you tend to be in the money markets or in the bonds, depending on what type of insurance company you are. And so the investment income that you get, your interest, primarily interest income, actually gets reflected in the premiums. Basically, the more you can earn by investment, then the lower the premiums, although it's comparatively small. And so they've talked about this in the book, about this hard insurance market when the investment income is low, which probably is like now. It can be quite hard to get insurance, or of course the other thing is the premiums could be high. But when there's high investment income around, interest rates are high, then often they'll take on further risks that may be unwise to do, but they take it on so they can get the money to make these investments. So because of that, this interest income that's part of their business, they have significant interest rate risk on their balance sheet. Significantly higher for the long-term stuff, like if you're in life insurance, than against general, but both have significant interest rate risk on their balance sheet because of the assets they're holding. Sit then. Okay. Any questions on that before we go to life insurance? moving on to life insurance. So the purpose of life insurance is, this is a depressing subject because, in the end, everybody dies. In fact, sometimes it's not called insurance, it's called life assurance because of the fact that everybody makes an exit at some point. And so if you have a whole of life, then it is a certainty that policy will be paid out. But the purpose of life insurance is to provide financial support to your dependents. If you have dependents, people depend on you financially, and you want to provide for them in the case that you die, then that is primarily what life insurance is for. So two basic types, the term and the whole of life. So how do they differ? How does term insurance differ from, well, how does term insurance work? And we'll ask what whole of life does. What does term insurance do if you buy something? Yeah, go ahead.
So you get life insurance for like, say, 20 years, and if you die within those 20 years, you get a payout. Whereas whole of life lasts, you get whole life.
Okay.
You get term is like, say you don't get life insurance once you retire, so you might just get life insurance until you're 65 or something.
Okay, so term insurance has a fixed period of time, and it actually runs out. Yeah, and so that's the key point about that, is that term insurance has a fixed date when it runs out. Now, often these things will have an option in for you to renew them, but they have a definite terminal date. Whereas the whole of life, the key thing about that, of course, the name explained it to you, is that it goes through until you expire. Now, life insurance salesmen are very cheerful people, and they always tell you about term insurance. It expires the day before you do, and when they're trying to sell you the whole of life. So cheerful people. So there are advantages to them, and if some of you end up as, say, private client advisors, the issues around whether you buy term insurance or life insurance is worth thinking about. So the term insurance, it's the simplest form, covers death only, and it's a fixed amount of time. And the good thing about them, if you're thinking about the needs for protection, the dollars that you pay on term insurance will buy you the biggest amount of protection. Okay, so if you need protection, and you don't, young family, got kids, wife's not working because she's looking after kids and all that sort of stuff, then what you really need to look at is term insurance, because this will buy you the biggest amount of protection for whatever dollar you have. Now, this one here, no investment features, is something that we see in the whole of life that's simply not here. There's some variations on them, depending on how the contract is written. The first one, what's called straight, you have exactly the same coverage for the specified period, and of course, as you get older, the probability of dying goes up, and so your premiums rise. So as time goes on, you pay more, coverage stays the same. This one here, renewable, fairly common to see that in a policy, is that you can simply roll this policy over. So if you come to the end of your term insurance, you have an automatic right to roll it over and continue it. The other one is the decreasing one. Basically, you pay the same dollar amount, but of course, as you get older, your probability of dying goes up, and so the amount of cover you get goes down. And the other one, which is quite common to see, is a convertible one, where you can start out with a term insurance, and then at some later stage, you can then convert it to a whole of life. Now, the thing about the whole of life, and this is the one that they like to sell you, and this is the issue. Let's draw a picture here of how this thing works. So we'll put dollars up there. So that's your covered. That's your cover up here, and this is your time along here. So in the whole of life, you simply make a constant payment throughout the life of this policy. And the premium, that's the amount of money you're paying into that insurance company, actually does two things. One is, it essentially buys you term insurance. So let's say, for example, you buy this amount of cover here. So this is your cover. That's the amount that you buy, whatever that is. And initially, when you've given them money, and you think about what they're going to do with that, because you're alive and well, they're going to invest that money, and the investment will grow over time. And let's say, for example, how on earth are they going to pay out if you die very young? So you die in here, and the amount of money that's been accumulated isn't very high. So one way of looking at the whole of life is that initially it is all term insurance. So it starts up there, and let's say there's the end there, because some of these, a lot of them, not all of them, none of them actually have a point at which you stop paying. Okay, but then the insurance continues on, and let's say that's the point where you stop paying it. So it's one of these ones that you stop paying. That goes down, and it ends up there. So that's the value of the term insurance as a component of this thing here. So initially, because there's no investment value, they haven't been able to invest here and things make lots of money yet, almost all the cover you're receiving from your whole life policy comes from the term insurance component. Now what happens is that if we make this one here, this is essentially the savings, what they call savings component, and of course it rises, and of course at that point there, it's taken over. So term insurance gone to zero, and this is the this is what we'll call the savings value, this one here. And as you pay in, they invest this money. It eventually rises to the point where it's enough to cover a payout. So this is the one that they like to sell you. They like to sell you the whole of life. Now the issue with this, and you should think about it both for yourself and if you're advisors, think about this for your client, is that the whole of life provides you two things. One is the actual life insurance itself, and the other thing it provides you with is essentially a savings component. So you get two things built into it. And if you are good at managing your money and you're disciplined and you can look after it, both those things you can do better. Okay, so if you're thinking about whole of life is a combination of term insurance plus a savings program of some description, and often in the contract it tells you what that savings program is. You can do better by going out and buying a pure life insurance product. And with the money that you have, you can buy a better savings product. So for people who can manage their money well, the whole of life is not actually a good option, because often the returns that when you think about how long that is, typically 40, 50, 60 years, this bit here, and think what risks do they face of actually not making it. Those risks are high, and often the returns that they're guaranteeing you there are pretty low. So if you can manage this well yourself, you can do better by buying a better life insurance product and a better savings product. Now, if you're not good at managing your money, you're not well disciplined, that's not you people, of course, but your clients might be like that, sometimes this is worthwhile. And you've got to weigh up those options when you're making that type of decision. Okay, any questions on that? Yeah, go ahead.
So do you, when you die, you get from a policy like that, you get some of the savings value and some of your term insurance value?
Yeah, let's say, for example, you went out and you said that was, say you bought $500,000 for whatever reason, and say you died at that point. Basically, you would get that value plus that value, which would equal this one up here. And, in that case, the insurance company will pay out your $500,000. But underneath the hood, a good chunk of that, let's say that's $300,000 there, $300,000, and $200,000 under the hood. $300,000 would be from the term insurance, and the $200,000 from the savings. Now, the other thing about these things is that if you get to the point in your life and you say, oh, actually, I don't need life insurance anymore, you can often cash these in. And so, and then they often talk about what they call a surrender value of the policy. It's this one here, this red one. Okay? So if at this point, say at this point you're still alive, and you think, I no longer need this insurance, and you say, okay, I'm going to cashed up, they would pay you that amount there. That's the savings component. And often, with these things on an annual basis, they will actually tell you what the surrender value is when you get your annual statement. It will tell you what the surrender value is, which is what this red line is doing. Does that answer your question?
Would you end up paying more than like more monthly?
No, you don't, because they're investing that, and there is a return on that. So typically that return, because of this very long-term nature, and the fact is that they're a profit-making business, that return is not very high. But if you think about how much it actually costs me, you will probably find, because you constant premiums, which get another color. Where's my color? This would be, your cumulative premiums. You might go to there. Okay, so your premiums would accumulate in straight line because they're constant, and then of course there's supposed to be investment return on top of this. Okay. Yeah. So the issues around these things, they're not that complicated, but you need to think about these things when you're making these types of decisions. Okay, any other questions? Okay. Yeah, some of these things, they are market linked. Now these things, if you're market linked, this red line can go down. Now typically with a fixed, but low, definitely low return, I mean it's steadily increasing. But with a market linked one, you can actually end up with the thing going down, so that you can end up like if you wanted to cash it in, you think, there's not much money there because the markets went down. And again, when the markets were going well, a lot of people opted for the market linked return, and of course, markets always have bad times, and then they found that they did not have the returns, that they had expected when they signed up for these things. So there's issues there to be thought about as to what type of insurance you're getting. And if you're going to, if you want a savings product and you're a good manager, there are better ones to get. Okay, there's my picture. Okay, let's see how it's happening. Okay, so this question, given the long-term nature of life insurance, how does it affect the structure of the balance sheet? And after that, we'll look at what risks. So if you're a life insurer and you're thinking about this, you're making very long-term financial commitments, how would that going to affect the structure of your balance sheet, particularly on the asset side that you have? Yep.
They hold a lot of long-term assets, like long-term bonds and other things, which exposes them to liquidity risk.
Okay, so the structure is going to have a lot of long-term investments, primarily bonds, and the very fact they do that exposes them at least to a liquidity risk. Any other risks that it exposes them to? Interest rate risk, yeah. So that's price risk plus reinvestment risk. So the fact that they're buying these long-term things, exposes them to interest rate risk. Now, when we looked at the banks and we calculated things like duration gap, the typical structure of a bank is that they had liabilities were quite short-term, they had assets were long-term, and so they had a duration gap. When we looked at the net duration gap, it was something that looked like just like a bond. So if the interest rate went up, bank value went down. Typically with these life insurance companies, it is the other way around because they can calculate the duration. You might think that's kind of hard to do, but they can calculate the duration of the policies. They can get these mortality tables, work out what the duration is on the policies, and then typically, because they're making like 30, 40, 50, 60, 70 year commitments, they have to have a very long-term duration on the liability side. And then, of course, often you can't get bonds that last long, and so you end up with a shorter duration on your asset side. And that gives you a net interest rate risk, which is, goes like that, rather than, banks, it goes like that as interest rate going up that way. Life insurance, they tend to be the other way around. So they tend to have an opposite maturity gap, duration gap to a bank. Okay, see if we missed anything. Yeah, in terms of the long-term ones, like illiquidity is quite an issue. If you think about privately placed bonds, there is often no secondary market at all. Even if you go for long-term corporate bonds, if they're listed on, say, on an exchange, we've talked about liquidity with there, and there's very little liquidity in those markets. And so if they want to sell these things, often they have trouble. And, interest rate risk, because of the long-term nation, high durations, high interest rate risk. And they have to manage all that. And, we saw that Apple looks after both their capital requirements and from a regulatory point of view and the liquidity so that hopefully they don't get into deep trouble. Okay, any questions that we go to property and casualty? Okay, moving along. We've got a few minutes left. So property, fairly obvious what that is. It gives you protection from your financial loss in case of something gets damaged. They call these things perils, peril, and fire, theft, that sort of stuff is what they call peril. Typically, there's two types of policies. There's things that what they call named perils, and that is where you have specified things that you're covered for. It's not on the list of things you're covered for, and something happens, then you're not covered. The other one, the all risk or the open perils, basically any loss covered unless it is specifically excluded. And have anybody seen this movie? Anybody seen this movie, The Man Who Sued God? Yeah? Did you think it was what do you think of it?
It was a
Long time ago. Oh, I don't remember. Anybody else seen it? It's actually, I thought it was hilariously funny. But this movie is one of the few that I know of that's actually based around the insurance industry. And I actually asked the actuary at AMI whether there was any truth to this story in terms of the actual basic story, or whether it was just something for fun. And to tell you what the basic story was, there's this guy. He's a lobster fisherman, and he has a fishing boat which he has, I think, an all-risk coverage on his boat. And one day, it gets hit by lightning, explodes, and it sinks, you see. Blood, 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 end of boat. And the guy from the insurance company out like this, act of God, and they don't pay. And there is often this clause in there. If you go look at there, an act of God, and you think, what is that? But anyway, I asked the guy at AMI whether the insurance company in this particular movie was within its rights to withhold payment in the case that a fishing boat got hit with lightning and sunk. And he said, yeah, they actually were. That's why they have that clause. That's why they have that clause in there. Is you think about the need to work out stats of how losses occur. Sometimes there are things that are just completely unforeseen, and you can invoke this particular clause. And he said, AMI wouldn't have done it. He assured me that AMI wouldn't have done it. They would have paid out. But the insurance company in the film was within its rights to say, no, this is an act of God, we're not paying. And of course, seeing how God did it, the guy decided to sue God. So if you're not offended by that sort of stuff, it's really quite funny, I think. It's worth watching. But there's other things you can insure yourself for. Liabilities, New Zealand, not New Zealand, University of Canterbury's got this insurance in case we do consulting and we mess up. Disability insurance, you can get hurt while we work. We've got ACC in New Zealand, but maybe want some more. Cars, marine, and so on. How's our time going? Looks like we run out, or has it got 1 minute to go? Okay, liability. So that's insurance against financial responsibility for harm to another person. And the thing is, if you might imagine what the university is like, we've got quite a lot of expertise within the university and often called upon to do consulting for various outside bodies. And the university requires us to go through a particular contracting process to do this. And part of the deal is that we have liability insurance. So if we give advice in good faith, we think is good advice, turns out to be bad, they suffer loss, they can sue the university. And so they have this type of insurance to cover that eventuality. Right. Marine insurance, despite its name, is really around transportation. So shipping, and vessels and cargo. And the last one, right. Okay, so we'll end at this point. We'll pick it up at this slide here tomorrow. So if you want to ask any questions, be around for a while. Otherwise, we'll see you, Friday, and we'll pick it up at this point.